In this video, I'm gonna show you exactly how I use the SOFI wheel strategy with options to collect $290K in options premium and how that fits into my bigger retire early journey. I'm gonna show you step by step exactly how I analyze companies to meet my wheel strategy requirements. And then I'm also gonna show you how I execute cash secured puts, covered calls, and a special strategy at the end of this video. So let's go ahead and dive into it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. Now let's dive into the portfolio. I do want to show you exactly proof that this strategy has worked for me personally. As you can see, the portfolio right here. If you do want to follow me along my 8-figure journey, then make sure to hit the subscribe button down below. And if you get any value out of this video, I would appreciate it if you hit the thumbs up button. Thank you. So let's go ahead and dive into it. We're going to go to the realized gain loss. And as you can see, year to date, 291K in options premium collected utilizing the wheel strategy, with SOFI being one of the positions in my portfolio. Obviously, results vary year to year, but I'm gonna show you exactly how I do it. And if you do want my free trade ideas, that will be on my Instagram and my free newsletter, which are both down below in the description. And if you wanna work more closely with me one-on-one and join my private options mastermind with 328 clients in there, that'll also be at the top of the description. And you could watch this training that I filmed for you, as well as some client testimonials that I post on a weekly basis. And you could book a call with me, and I look forward to seeing you there. So let's go ahead and jump into it. The 3 criteria for the wheel option strategy. So a lot of people get this part wrong, and it's very crucial that you pick the right stocks for the wheel strategy. Because if you pick a stock that is consistently going down in price, it's not gonna work for you. So I'm gonna show you exactly why SOFI meets that criteria and exactly how I analyze and pick perfect stocks for the wheel option strategy. So number 1 is gonna be a great chart. So if we look at SOFI, okay, we could see that for the past year and a half, I like to go back a year and a half. So we're gonna go to 2024. All right, you're gonna see that the chart has been upward trending. Okay, so all you have to do is draw a line from that point a year and a half ago up to where the stock is now. And as you can see, nice upward trending chart. So that makes it very easy to trade the wheel options strategy. Now, if you're wondering what this diagram on the right or left of me is, we could kind of cover it, what the wheel strategy is, just a brief overview, and then I'll dive into the nitty gritty. Now that we know that SOFI has a great chart, we'll get into the other two. But first, what we do is we sell cash secured puts and we're collecting premiums. So what that is basically there's someone out there who will buy a put option from me because they want to get out of their 100 shares that they own if the stock goes down to a certain price. Now, why would they want to do that? Well, let's just say they've owned Apple since it was at 20 bucks, right? It's at 100 now. And if it goes down to 80, they just want to get rid of their shares. They want to take their profits and not lose any more of their profits, okay? Now, I would be forced to buy those shares at a discount, right? Because the stock would go below my put price. So we sell puts, we collect premium. It's basically like, think of it like car insurance. We pay a premium every month for car insurance, but most of the time we'll never use it, and we probably will pay more premium than what the car is actually worth, just in case, okay? And that's exactly how insurance companies make money. Well, this is how we make money with the wheel strategy. We collect premiums on the puts. Eventually, the stock goes below our put price. We're forced to buy 100 shares, but we got paid to basically dollar cost average and get that stock at a discount. Once we have those shares, we then sell covered calls against our shares above our cost basis. So eventually, the stock goes above those covered calls by expiration, and we'll be forced to sell our 100 shares at a profit, so we get appreciation, plus we get a premium, okay? And then we do it all over again. So sell puts, get assigned shares eventually, maybe 2 or 3 months down the line. Then we sell covered calls, then we get the shares called away, and we do it all over again. So I'm gonna show you how that works nitty gritty later on in the video. But the second part of this is the stock has to have great valuation. So ideally, I like stocks that have a PE ratio under 100, especially because I'm trading high growth stocks. So the PE ratios will be higher than the S&P 500 average of 26, but lower than 100, okay? That means they're earning enough per share to, pay out investors, buy back their stock, invest into the company, and make that, stock price go up. So PE ratio has to be under 100. If they don't have a PE ratio under 100, then I look at the cash on hand. So we're gonna look at SOFI, all right? And I'm just looking at tradingview.com. This is a free website that I like to use. I pay for the subscription, but you don't have to. If I go down here, I could see their PE ratio is 52, okay? So great, it's under 100. For an online banking stock, it's definitely a little bit higher than like a traditional bank stock, but they're online banking, they're into the AI banking space. They are doing a lot of things that are not, traditional, and that's why they're considered a growth stock, okay? So 52 PE, that looks good. Now what we'll do is I wanna dive into, what the stock, how does, certain economic factors influence the stock, very basic ones, and how do they generate revenue, okay? So one thing about banks is they're highly sensitive to interest rates, all right? We're in a high interest rate environment right now, so that's not that good for banks, right? Because not a lot of people can afford to pay high interest on loans. So banks benefit when interest rates start coming down, okay? They don't benefit like when interest rates are almost at zero because they can barely collect any interest fees, right? But they benefit from the transition of high interest rate to low interest rate. So as you can see right here, we're looking at the CME FedWatch tool. We can see that there's going to be an interest rate cut in September. By the time you're watching this, maybe the interest rate cut already happened, okay? 2025 September. There's gonna be another one most likely in December 2025, then another one in January 2026, right? And multiple on the way in 2026. So that's gonna be good for SOFI because people are able to refinance their homes, refinance their auto loans, their student loans, and that's everything that SOFI does. So if we look at their investor relations booklet, we could see record revenue growth, 44% year over year this past quarter, Q2. So that's great, double-digit growth in their revenue. All right, double-digit net income margin, okay, that's good, 11% net income margin. And you could see that they're, executing everything that they sought out to do, right? They launched their home equity loans, they launched their paid SOFI Plus subscription this year, right? And that's how they're collecting fees as well as people are using their app, which they pay, I believe it's $10 a month, and they get access to certain benefits like high yield savings account, AI investor advice, right? There's lots of different things that they get benefits from, okay? So what I see is that home loans are gonna be a major profit center for them, as well as student loans going into this lowering interest rate environment, okay? And that brings in a lot of other customers, and once those customers come in, they can offer other services like credit cards, SOFI Invest, right? SOFI Protect, maybe some insurance products, stuff like that. So that's what I like to see. I like to see that their members are growing every year. Q2 2025, 11 million members, okay? That's pretty insane, 34% growth rate. So still double-digit growth in their members, right? So this is a company that is growing rapidly right now. So it's in the growth phase. They just went positive on their net income in 2024. Okay, so this is the second year they're actually earning a net income after taxes, expenses, depreciation, interest, all of that, right? So that is what we want to see, all right? So we're in the early innings of SOFI and they're generating more revenue, more customers, and it looks like they're doing a great job with the company, okay? So now that we have the valuations underway, and I do these valuations for you. So when you watch my channel, you'll see that I talk about a few different stocks that I do the wheel strategy on so that, you don't have to do the research as in depth. You can kind of look at what I'm giving you and then compare it to, what you find, right? So that is why I like, number two, great valuation. So number three is going to be great premium. So because we're selling puts and selling covered calls, we want to make sure that there's at least a 2% ROI there for us to collect, okay? So let's go ahead and jump into it. One thing I do want to talk about is the VIX levels. So The VIX levels are very important because what this is basically the fear and volatility index. So if we go to the charts, all right, this is the fear and volatility index of the S&P 500. So this shows us, how much cash I should be allocating during times of greed or during times of fear. And with options, because we're selling insurance products, right? We're selling stock insurance essentially. Options premiums are highest when fear is high, right? Like if there's a car out there that's been in a lot of accidents, the insurance on it is going to be higher than maybe another car that has been in no accidents, right? So it's the same thing. When the VIX is high, insurance premiums are, put premiums are way higher, right? And that's an opportune time to allocate, for me, 100% of cash. Like right here when the VIX spiked up to 60 and QQQ, had a massive tariff crash. Okay, so that's exactly when the VIX spikes up. Now, right now we're at a very low point. Okay, VIX is under 15. So if we go back to the levels, we're right here, VIX 12 to 15, which is barely any fear in the market, little to no fear, in fact. So that tells me I could have 40% cash on the sidelines all the way up to 80%, which I don't do because I'm definitely more aggressive. Right now I have like 15% cash, so I'm not quite following these levels to the T, but these will keep you safe in the event of a crash or something like that, to where, you'll have, I'll have a little bit of cash on the sidelines for when the stock market does crash to take advantage of those high options premiums. So just something to be aware of. Look at the VIX levels. This is something that I do, probably one of the most important indicators I look at when selling put options. So let's dive into it. The wheel strategy on SOFI, cash secured puts. So how it works is, let's just say SOFI is trading at, I think right now it's trading around $25. So $25 right here. We're going to sell a put option. So I'm going to sell a put option right here at X at 23.5. Okay. So maybe I collect $100 on that per contract. So if the stock stays above 23.5 by expiration in 30 days, cool. I collect my $100 and I do it all over again the next month. And let's just say the stock, trades all the way down to 24 in the next 30 days. Well, I collect my $100 again and I do it all over again. Well, let's just say the third month, okay, the stock, I sell that 23.5 put and the stock falls all the way down to 22. Now I'll be forced to buy 100 shares at 23.5. So that's $2,350 for that 100 shares. Okay, but I still get to keep that premium. And then now I have shares and I could sell a covered call. But let's first kind of walk through exactly how I sell cash secured puts. So I do a 20 to 30 delta, which is a 20% chance of being in the money or the stock falling down to that point, or 30% chance of the stock falling down to that point. Now, the higher the chance, the higher the premiums, okay? Because I would essentially be taking more risk. So I like to sell like 30 delta cash secured puts, especially on SOFI, take a little bit more risk and collect a little bit more premium. I like to go 30 days to expiration for monthly income. So I don't have to be sitting in front of the computer screen every day watching it. That's not what I like to do. I don't day trade. I just focus on swing trading, monthly options, and I like to enter on red days. So let's go ahead and go into the portfolio. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. But if we go into the portfolio, okay, you could see my SOFI position right here at the bottom, 136K in cash secured puts. So I'm going to click in there so you could see. And we have currently 58 put options at the 23.5 mark. So I did this exact trade that I'm talking about, okay? Sold all of these put options to collect $4,727. Now, if I go to the options chain, okay, I would do the same thing. I would go to September 26. I would sell the 23.5, which is a 30 delta, and I'd collect about somewhere around $90 per contract, okay, which is a 3.98% ROI. Results vary depending on where the stock is trading, okay? So that's a pretty good ROI there, right? In 30 days. I like that. So I'm going to sell that put option, okay? By clicking the bid. And then that'll pull up sell one September 26, 23.5 put. And, most of the time you'll hit the mid price or the bid price, right? And then review and send, and boom, that is exactly how I enter the trade. So that's exactly how I entered these trades. And, very nice premiums there that I like, and it hits my return goals per month of anywhere from 3 to 5%. I try to hit those ranges. Okay, obviously results vary month to month. So that is exactly how to do the cash secured put. Now let's talk about the covered calls. Let's just say I got assigned on those shares at 23.5, okay? Or we'll talk about it maybe 25. But basically, let's just say I got assigned at 23.5. I'm gonna sell like a 25 or 26 covered call. So something far above my cost basis so that I could get some appreciation and then eventually get my shares called away and get some premium as well, okay? So let's just say this month I sell the 26 strike covered call against my 23.5, my shares at 23.5, and the stock finishes at 24. Okay, I get to keep that premium. Maybe it's $100, keep that premium, do it all over again. Let's just say the second month I sell the 25 covered calls. So to collect a little more premium and be a little bit closer to where my stock is trading, but then the stock goes to 26, okay? By expiration, I'm gonna be forced to sell my shares at 25, even though the stock's at 26. So I get appreciation plus the premium, okay? So what I like to do is sell 30 Delta covered calls. I go anywhere from 15 to 30 days to expiration for monthly income, and I enter on green days so I could get higher up above my shares, okay? So, and what's cool about the covered calls is, I could just wait until expiration, let the shares get called away, or enter a new covered call position. So I'm gonna show you exactly how I do it. Okay, let's just pretend that we're gonna go out like 23 days, okay? Let's just pretend I got assigned today at 25, all right? Stock's trading at 25.12. What I'm gonna do is I'm gonna go to that 30 to 35 Delta. I could go all the way up to the 28 strike, okay? Which is pretty decent, right? Because that's gonna give me over a 2% ROI on the covered call. So I like that, 28, right? And then appreciation wise, it would have to go all the way up past 28. So that's, at least 4 or 5% there in appreciation. So it's double the income, right? It's appreciation, maybe 4 or 5% plus the premium, 2%. So overall on that, I'm getting like 6 to 8%, right? If the shares get called away. So again, if I want to ensure the shares get called away faster, I'll go to a higher Delta, maybe a 40 Delta to collect like 3%, but less appreciation. But either way, the shares might get called away faster, has a 40% chance, right? So either way, I like to go somewhere between 30, sometimes even 40 Delta to be very aggressive, as long as I'm above my cost basis of 25, okay? So that's the covered calls. You do that, I'll do that on every 2 to 3 weeks, right? 23 days out. Once that is over, if my shares didn't get called away, I'll do it again, okay? Until my shares get called away. So that's exactly how to do the covered calls and collect premiums there. Now, there's one last strategy that I do to supercharge the ROIs, okay? So what I do is, and this is not part of the wheel strategy, this is just how I modify the wheel strategy to fit my needs, is I buy a Leaps call option. So I don't like buying options because you're paying a premium to own something that decays over time. But if you do it right, if you do it the way I do it, then you at least have enough time to be right. And you could kind of lever up the money to, supersize the return. So I'm gonna show you exactly how I do it, all right? So buy 70 Delta Leaps, at least 1 year out. I like to go 400 days plus. Stock has to be below the middle Bollinger Band to lower Bollinger Band when VIX is above 15. And then I sell the stock I sell the option once the stock is above the middle Bollinger Band. So let's go ahead and go to the chart, all right? And we're gonna go to SOFI. And right now would be a bad time to buy a Leaps call option. This would have been the perfect time because we're below the middle Bollinger Band line. And what these Bollinger Bands are is basically these top and bottom lines are 2 standard deviations away from the average price, meaning in simple terms, the stock's gonna stay in between these 2 lines 95% of the time, okay? And when it goes outside of there, it tends to suck back in. Same when it breaches the lower, right? It breached the lower back here during the crash and then sucked back in, breached the upper, sucked back in, as you could see, okay? So it's pretty predictable. And this would have been a good area to buy. Now, this is not a good area to buy, but this area would have been great, okay? I would have bought a Leaps option here, and then I would have exited once it passed that mid-Bollinger Band, so probably somewhere right here. And typically I'll make, 10 to 20, sometimes 30% on these quick moves, okay? So obviously results vary, but it's pretty, you have to wait for the entry, but it's very fun to do these if you get a good entry. So what I'll do is I'll go to the options chain. I'll go out, I went out to January 15th, 2027, which is 506 days out. And I'll buy the 70 delta, or at least as close to 70 delta call option as possible. So there's no 70 delta, but I like to be above 70, if anything. I wouldn't go to 67. So I'd get the 22 strike call option, which would cost me about $900, okay? Now, to buy 100 shares today, that would cost me $2,500. So I have a leverage factor there of, almost 3x. So I like that, right? Because I could buy this and I don't have to buy 100 shares, but I get to control 100 shares for $900. Now, mind you, there is theta decay. So this is decaying at about 6 cents per day. So not that much because we're so far out in time, but still you have to be aware of that. So I like to buy this. And then again, once the stock goes above that mid-Bollinger Band line, I will sell this option to make a profit, okay? Now, if you enjoyed this video, please give it a thumbs up, and I'll see you in the next tutorial. I'm gonna link right here. Check this one out, and take care.